moment you start to trade, you enter a journey that will never stop. It will last your whole lifetime. Every day you have to fight or work with or try to manage this journey as a trader. There won't be a single day where you don't encounter all three these issues I'm going to discuss now. So everything I design, everything I do on trading consists of the following three things. That is what we call the 3 M's: the mind, the money, and the method. Every day you will have to play the mind game and not allow fear to cause any trading errors. Now that is a sound individual psychology. Now I will dedicate a whole video on that, but just understand you will have to work on your mind on a daily basis, every trade, every day, every week, every month, every year, for the rest of your life. And you will have to manage your money. Money management is one of the most important things keeping people alive. So you will have to manage your money with a sound risk-reward ratio and also protect your cash with a stop. We call that a good money management plan. And then thirdly is a method. Now method is what we call a strategy, but there's more into a method than just a strategy. A strategy is a set of rules. A method is the set of rules plus much more. You must find a method with a positive expectancy that makes more money when you're right than when you're wrong, which you can execute without any fear or hesitation. Now we call that a logical trading system. Now let's have a look quickly at all three of them individually. To win the mind game, you will have to play this game consistently, always. You can never drop your guard on your mind. There will be 4 fears that will be in your face every single day of your life, and you will have to work diligently on those 4 fears, making sure that they don't allow you to make trading errors. The 4 fears are being wrong, losing money, missing out, and leaving money on the table. Let's have a quick look at each of them. People are very worried to be wrong. In our society today, when you're wrong, you pay the price. Now, in the markets, you're never wrong when you have a losing trade. It's just your strategy that will make eventually enough money for you. Failed this time, but that doesn't make you wrong. All right. So the fear of being wrong will paralyze you that you will never take a trade. You will overanalyze to make 100% sure that this trade can't fail. Because people look at you, and when you have a bad trade, they will go, oh, so your analysis was wrong. No, your analysis was not wrong. You have a plan, you have a strategy which you will execute day by day by day, trade by trade by trade. That doesn't make you wrong. So put that fear aside of being wrong and accept it that you're going to have a lot of losing trades in the markets. The second one is people are fearful of losing money. You've worked hard for your money. It's your hard-earned money, and now you put it in the market. You've done your analysis, and now the trade just goes south. And this is where usually people start to remove stop losses, because they don't want to exit the trade, because the moment you exit the trade, you're realizing the loss. And people don't want to be wrong, and they don't want to lose money. And that's why people do then these stupid things like removing their stops or moving it at a lower level or adding onto a losing trade. So losing money is part of the game. I'm going to teach you how to exactly manage your money in a later video to make sure that you don't lose too much when you're wrong. And then the fear of missing out. Oh, I've seen this so many times in my mentoring programs, is that people are fearful of missing out on a big move. They will jump in too early. They would want to, pick the bottom of the market, or they want to pick the top of the market. Now, that is a bad thing to do. You'll every now and then get it right by accident. It's pure luck, it's not skill. But missing out is one of the bigger things where people prematurely enter into a trade because it looks like it's going to rally, and just as you enter, the market starts to turn against you, and then you start doing stupid things. So we cannot allow the fear of missing out. You've got a plan, a strategy which tells you when A then B, when B then C, if not C then D, and so forth, and you stick to those rules 100% of the time. But preempting a trade, that's a bad thing. And then leaving money on the table. I like to trade with targets, and once you start trading, you'll understand this better. But let's say you took a couple of trades and you see your account is up $1,000 in the plus. And the next morning or an hour or two later, you come back and you see, oops, I'm only $800 in the money. Your brain doesn't say, you know what, you're up $800. Your brain now tells you you've lost $200. It takes away the excitement of profits by watching your balances too much. But that's the one part of it. Then the fear of leaving money on the table is also, you always want to predict the top of the market. Let's say you are going long in a trade, you bought something, and now it's getting to your target levels and you want to hit the target levels, and now you start moving the target because it looks like it's going to go further. It looks like it's going to go further. And then you start moving because you're so worried that after you hit the target, that the market keeps going. And I can guarantee you that will happen. And it will happen a few times in your life. And that's going to make you question your whole strategy. You're gonna want to change your strategy just to next time not leave any money on the table. What do we all want? We want to hit the targets on the nose, and then the market reverses, and then we can say, we were right. No, that's not what it's all about. You must hit the targets where it is, or your trailing stop losses, and if it then after your exit goes further your direction, so be it, that's someone else's profit. And then there's managing your money. Now, people always ask me, what do I do? And I always joke and say, I'm a professional risk manager. Because that's what you do in the market. You manage your risk. If you manage your risk, the profits will look after itself. You must just make sure that you're always in control of the risk in the market. So looking at your money situation, the first decision you will have to make is, how much money am I going to put aside for speculative trading? Speculative trading means higher risk trading, not investment. So how much will that amount be? That must be an amount which you are comfortable to lose. That amount must be the amount that if you lose that all, it will not make a dent or change your lifestyle at all. It's not your kids' school fees or the university fees or taxes that you must pay in 4 months, and now you want to trade with the money quickly trying to make more money. No, it's money that you put out for risk and say, I'm willing to risk this amount of money. If I lose this, it will not change my lifestyle. And the second thing will be, how much of that money will I be willing to risk on a single trade? Now, in general, 1 to 2% of that amount is what you will risk on a single trade. I prefer the 1%, but yes, under certain circumstances, which I will teach you, you can go up as high as 2%, but never more than that. That means if you start with $1,000 account for argument's sake, and you say I'm going to risk 1%, that means the next trade you take, if it fails, you lose $10. If you risk 2%, if it fails, you will be losing $20. That's like going to the casino and gambling. When you put money in the machine, if you put $5 or 5 Rand or whatever it is in there, it will only take that amount of money, no more. I'll teach you exactly how to do that. So I'm not meaning exposure. It's not that you're going to only expose yourself to $10 out of $1,000. It is the risk. It's how much can you really lose if this trade goes from entry to stop loss. And remember, in money management, one single trade must never be an issue. If you catch yourself sitting until 4 o'clock at night watching a trade because you are worried about it, sell to the point of sleep, as simple as that. Never bet the farm, never bet everything. Always stick to your risk reward rules. Never ever allow one trade to rule your decisions, or never allow one trade to get out of hand. It's very important for a trader to have cash, because the next day you need to be able to trade again. And if you lose all your money on a single trade or doing something stupid, you will not be able to trade again. You will have to fund more of your hard-earned money, and that is definitely not the best way of trading. Always remember, you don't want to be greedy. Little by little, the wise man becomes rich. Now, just to wrap this up with a little story, in my early years when I was also very much of a cowboy on trading, there was a share Edgars before they got delisted in South Africa. Very nice trading share. And I also was cowboy, lost all my money in my account, but I wasn't even aware of it. When I phoned the broker in the morning saying, I want to buy some Edgars shares, he said to me, but you can't. There's no money. I said, that's impossible. You've lost all of it. So I had to fund the account, and by the time the account was funded, the market really started to rally. And that was the trade of the decade. I've never seen so many white candles going my direction without me in the trade. I sit on the sideline because I didn't have money to take the trade. So learn from that small little lesson there, guys. It's important to manage your risk and to make sure that you do not lose too much money when you're wrong. You only want to lose 1 to 2% on every single trade when you're wrong. And when you're right, you need to make more than that. And that's why we need a good risk reward on any trade. Then your method management, that's managing your strategy. Now, when you design your strategy, you must take a lot of things in consideration. The first thing is that your method must have clearly defined characteristics and rules. You must know what to do under all circumstances. You can never not know what to do next. That means you're outside of your strategy. It must make more when you're right than when you lose when you are wrong. And it must have a good hit rate and a good risk to reward. I always say, what is a good hit rate? Or what is a 60% hit rate means? People will say, you're right 6 out of 10 times. I said, no, that means you're going to be wrong 4 out of 10 times. Just the mindset, just to change the mindset. I know it's the same thing on paper, but that means you're going to be wrong 4 out of 10 times. People always focus on, no, I'm going to be right 6 out of 10 times. Yes, that's true also, but you're only going to be wrong 4 out of 10 times. You must expect realistic returns. You cannot go and trade with $100 and think you're going to double it every 2-3 months. That's nonsense. You're going to trade slowly but surely. You're going to make your money that you need to make. But do not come into the market with $100 or $500 and think you're going to make $2,000 or $3,000 or $10,000 profit. That just don't happen. That's usually just a few luck shots some people will catch. They will usually record it and punt it on YouTube and think, this is what's possible. No. And I've been doing this for a very long time. You get your luck shots every now and then, but that is not repeatable. And it's very important that you can do it again and again and again and again. So remember, when you develop your strategy, that you expect realistic returns. It must suit your personality, your emotional tolerance, and the capital you've got available. It doesn't help you design a strategy on the DAX and the minimum position is so big, very profitable strategy, but you got $100 or $500 in your account. You will not be able to sit through the drawdowns. Your account is too small. You must have your emotional tolerance. What can you handle dollar-wise or rand-wise or whatever you trade in your currency? What can you handle? What can you lose before you get too emotional? Depends on your personality, who you are, what type of person you are. It must suit you as a person. You must be comfortable with the strategy, executing it again and again and again. So on the end, you must develop a plan and execute it with the absolute correct mindset. And finally, your strategy must have a positive expectancy. Now, I will make a separate video to explain exactly what is positive expectancy. But that's what we're after. A strategy must have a positive expectancy, meaning that over time it will make you profits. Although every now and then you might see some drawdowns, but over the long term you will see your account grow steadily.